Hi friends, this is Rahul Jain, and in today's video we are going to discuss risk and reward and how they two correlate. See my screen and tell me, if I ask you to pick one stock, which will you pick? Both stocks potentially may give 10% returns. However, stock 2 has a risk of falling down by 5%, while stock 1 has a risk of falling down by 2%. Obviously stock 1, right? Now see my screen and tell me, if I ask you to pick one stock, which will you pick now? Both stocks potentially may fall down by 5%. However, stock 2 can potentially give returns of 10%, while stock 1 may potentially go up by 5%. Obviously stock 2, right? And this brings me to an important concept that investors use called risk versus rewards. Before investing in a stock, investors assess the potential risk and potential rewards and come up with the risk versus rewards ratio. So in our example 1, the risk versus reward ratios are for stock 1, 2:10, stock 2, 5:10. In example 2, the risk versus rewards ratios are stock 1, 5:5, stock 2, 5:10. Lower the risk versus rewards ratio, better it is. And what you see in this chart is we need to pick stocks like stock number 4 and avoid stocks that are like stock number 2. Now comes the question, how to calculate potential risk and return values for a stock at any given point in the time. So the formula is risk is equal to entry price minus stop loss price. Returns is equal to target profit price minus entry price. Entry price is the price at which an investor wants to buy the stock. Stop loss price in this case will be the price of the stock at which the investor holding the stock will choose to sell it to prevent further losses. And target profit price is the price that the investor is expecting the stock price to rise. At this price, the investor will sell the stock and book profits. As you can see, every investor may have different stop loss price, target profit price, and entry price. The risk-reward ratio may be different for different investors. However, there are various methods that investors use to arrive at these prices. For example, one of the methods is to use the previous 52-week lowest and highest price. An investor may set the stop loss price equals to previous 52-week lowest price and may set the target profit price equals to previous 52-week highest price. So in summary, using risk-rewards ratio, investors can assess various stocks and can make investing decisions knowing the potential risk and potential rewards. I hope you found this insightful. I'll see you in my next video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.